Picture this. A line of colossal container ships waits at the mouth of the Yangshan deepwater port in Shanghai, their hulls packed with everything from smartphones and sneakers to toys and treadmills. Behind these ships, a city of cranes, trucks, and bustling workers moves with military precision. But beneath the surface, anxiety ripples through the global supply chain. In May 2025, a single handshake between Washington and Beijing hit the global economy like a tidal wave. The United States and China agreed to a 90-day pause on their punishing trade tariffs, slashing them from a crippling 145% to just 30%. The clock started ticking, and 3 months, experts say, may turn the world's trade order upside down. But what's really at stake in these 90 days? Is this a rare window of opportunity or an opening act for more chaos and volatility? And how can businesses and consumers brace themselves when cargo surges, supply chains tremble, and superpowers recalibrate their every move? Strap in, because over the next 20 minutes, we'll dive deep into the real story behind the US-China tariff pause and why this short ceasefire could trigger ripple effects far beyond the ports. Let's rewind for a moment. Trade wars rarely erupt overnight. The US and China, world's twin economic giants, have been locked in a titanic contest for over a decade. But tensions ramped up dramatically during the Trump administration, when tariffs became the weapon of choice to tackle America's massive trade deficit, force intellectual property reforms, and rebalance a system that many in Washington saw as rigged. At its peak, the tariff barrage was brutal. By early 2025, some Chinese imports faced duties as high as 145%. U.S. exporters, from farmers in the Midwest to tech giants in Silicon Valley, reeled under retaliatory tariffs and rising costs. Shipping lanes that once pulsed with steady commerce became erratic. Suddenly, the world's supply chains, finely tuned for decades, began to seize up. In response, global logistics firms scrambled to adjust. Mike Short, president of global freight forwarding at C.H. Robinson Worldwide, describes how, when the tariffs on goods from China abruptly accelerated in April, demand abruptly dropped. Customers, whether they were big-box retailers or small e-commerce startups, had to make hard choices: stockpile goods ahead of new tariffs, reroute their orders, or risk costly delays. Some, Short notes, took a wait-and-see approach, while others ramped up imports, gambling that the storm would soon clear. Meanwhile, ocean carriers, those massive ships that form the backbone of trans-Pacific trade, started pulling capacity from Asian routes, repositioning vessels and equipment to chase demand wherever it emerged. The cost of shipping a single container soared, just as retailers struggled to predict how much stock they'd actually need. Southeast Asian ports, Indian factories, and even Mexican assembly lines suddenly found themselves flooded with interest as companies desperately sought alternatives to Chinese suppliers. And then, almost as quickly as it escalated, the tide shifted. On May 12, 2025, after weeks of shadowy negotiations, President Trump's administration and Beijing announced a breakthrough. For 90 days, the U.S. would slash tariffs on Chinese goods to 30%. For shippers, logistics companies, and global manufacturers, the implications were electric. Shelved purchase orders were dusted off. Warehouses in China began humming, as Paul Brashear of ITS Logistics revealed. "I have clients with thousands of containers preloaded in China that are ready to come in." Still, excitement is tempered by uncertainty. Customers that had cargo stored at origin are ready to ship. Others are cutting purchase orders this week and asking suppliers to produce as quickly as possible to get their goods out in the 90-day window, says Short. Yet not everyone is diving in head first. Industrial manufacturers, whose supply chains work on months-long lead times, are hesitant to overcommit in such a precarious market. If lead time on the machinery you make is 8 or 9 months, and you're facing a possible recession, you don't stock up on materials you might not need. With the tariff pause, ports and logistics networks are bracing for a surge. The Port of Los Angeles, the busiest in the U.S., is still running below its pandemic-era peak, but insiders predict that could change fast. FedEx Corporation, one of the world's top logistics players, keeps a close eye on paperwork and compliance, warning customers to have paperwork completed correctly ahead of pickup so shipments can continue to move seamlessly through our network. Banking and investment houses are watching nervously. TD Cowen notes, "The 90-day pause opens a window of clarity for shippers. But even as ocean carriers scramble to ready more vessels, bookings through the Port of Los Angeles remain only 80% of their year-ago levels. Are shippers still holding their breath, waiting for another twist?" Some numbers tell the story best. In the first weeks of May, container throughput at major Chinese ports jumped by 14.3%. The Shanghai Containerized Freight Index shot up by 8.2%. IHS Markit projects a 25% spike in U.S. electronics imports from China, and the National Retail Federation estimates American retailers could save as much as $3.1 billion in tariff costs during the pause. A massive 76% of U.S. companies told the AAIE survey they plan to increase orders from China right away. Yet for every winner, there's a potential loser. The U.S. trade deficit with China stood at $295.4 billion in 2024, up nearly 6% over the previous year. As more Chinese goods flood into the U.S., could that gap widen even further? Chris Williamson, chief economist at S&P Global Market Intelligence, warns, supply chain delays are increasing and tariff levies are causing prices to rise for consumers. Meanwhile, Chinese exporters are moving with lightning speed. The Textiles Intelligence Report predicts an 18% leap in U.S.-bound textile and apparel exports from China. Online retail giants like Shein and Temu, once struggling to keep up with back orders, now eye a rare opportunity to restock U.S. warehouses at a discount. But the picture isn't all rosy. Jamie Dimon, CEO of JP Morgan, raises a chilling warning. Stagflation in the U.S. economy is possible due to geopolitics, deficits, and price pressures, making the tariff pause insufficient. If inflation returns, will consumers' savings be quickly wiped out by higher prices and falling wages? For major brands and multinationals, the 90-day window is both a gift and a riddle. Apple, for instance, is already shifting about 20% of its US-bound iPhone production to India, hoping to shield itself from future tariff whiplash. VTech, meanwhile, has announced it will move all US market production out of China by 2026. Such moves highlight a deeper truth. Beneath the surface, companies are quietly hedging their bets, preparing for both opportunity and disaster. The stakes are high for supply chain managers and investors. The US dollar hangs in the balance as trade flows ebb and surge unpredictably. Haiben Zhu, China chief economist at JP Morgan, highlights the risk. The tariff reduction could boost China's growth, but there's a risk of tariffs returning if no broader deal is reached. And let's not forget the world's seaports, rail hubs, and trucking routes. The ITS Logistics U.S. Port Rail Ramp Freight Index points to heavy import volumes and pent-up demand ready to erupt as the peak retail season approaches. Shippers should be prepared to increase trucking and equipment capacity immediately, warns Paul Breschier, to ensure they can withstand volatility and get their goods to market on time. Yet even as vessels fill up and ports brace for impact, uncertainty clouds every decision. Some analysts predict a short-term boom, a frantic rush to import as much as possible while tariffs remain low, followed by another cliff edge if talks break down. Others imagine a longer truce, perhaps even a comprehensive deal, returning predictability to a battered system. But a third camp, hardened by years of trade skirmishes, fears this is just a lull before the next trade war, with new tariffs, new disruptions, and new winners and losers. Scott Kennedy, of the Center for Strategic and International Studies, argues the U.S. may have retreated too far. The tariff pause represents a retreat by the U.S., with China gaining most of the desired relief. But did Washington really blink? Or is this the opening move for a larger, more hard-fought renegotiation? Across the Pacific, hope and caution intertwine. Gene Soroka, executive director of the Port of Los Angeles, observes, a cautious approach is expected from importers, limiting the surge in imports except for critical commodities. For every company racing goods into the U.S., another hangs back, waiting for more clarity. The next weeks promise a logistical roller coaster. Will the tariff pause uncoil pent-up demand, spark a sustained recovery, and let supply chains finally breathe? Or will it simply unleash another burst of chaos, fueling inflation and reshuffling global trade once more? As the final weeks of the 90-day ceasefire tick down, businesses, policymakers, and everyday consumers are left with one burning question. Is this the calm before a breakthrough, or just the eye of an even bigger storm? As the cargo ships line up at the Port of Los Angeles and warehouse managers scan the horizon for new shipments, one thing is clear. The global economy is holding its breath. The U.S.-China 90-day tariff pause, heralded as a breakthrough for some, feels more like a high-stakes timeout than a genuine resolution. So what happens next? Let's gaze into the future and explore the possible consequences, risks, and opportunities that this fragile truce really brings. First, the immediate future. Over the next few weeks and months, we're already seeing the effects ripple through ports and supply chains worldwide. Container throughput at major Chinese ports shot up by over 14% almost overnight, as ocean carriers scrambled to reposition ships and shippers dusted off cargoes that had been held back for months. The Shanghai Containerized Freight Index, essentially the price tag for moving goods by sea, jumped by more than 8%, a sure sign that demand is surging, albeit with considerable volatility. Pent-up demand is now flooding into the market, especially from retailers who rely on affordable goods from China. The National Retail Federation estimates U.S. retailers alone could save more than $3 billion in tariff costs during this brief window. In theory, that means lower prices for consumers, at least for the time being. Experts like Mike Short from C.H. Robinson see a mad dash to ship goods, with importers racing the clock to get their orders in before tariffs could snap back. But beneath this surface-level relief, there's a powerful undercurrent of anxiety and calculation. According to a recent AAIE survey, more than 3/4 of U.S. companies are ramping up their orders from China. Yet many are hedging their bets, reluctant to go all in when the future remains uncertain. As Gene Soroka, executive director of the Port of Los Angeles, puts it, importers are moving forward, but with caution. Only critical goods are seeing the biggest surge. Even as container imports from China surge, up 25% for electronics and nearly 18% for textiles, according to IHS Markit and Textiles Intelligence, others are planning for a different future. Brands like Apple are shifting as much as 1/5 of their US-bound iPhone production to India by 2026. Toy maker VTech is preparing to move all production for the US market out of China completely. These moves signal a deeper structural shift, diversification of supply chains, just in case another tariff shock hits. So what are the big picture scenarios that could unfold when the 90 days are up? According to the latest analyses, there are 3 distinct futures in play. First, the optimistic scenario. The tariff pause buys enough goodwill and time for the US and China to hammer out a comprehensive trade deal. Under this outcome, both sides agree to lower tariffs in a gradual, predictable way. Trade volume increases. Supply chains stabilize. Retailers, shippers, and manufacturers from both countries breathe a collective sigh of relief, and the broader global economy enjoys renewed growth. This is the dream scenario: more cooperation, fewer barriers, and healthier competition. But then there's the most likely outcome, at least according to many experts: an extended pause, where neither side fully commits, but both avoid escalation. The 90-day window could become 120 or even 180 days. That sounds good, but in reality it means a lingering sense of uncertainty. Businesses continue to hold back on major investments, always fearing that the next round of tariffs or diplomatic dispute could upend their careful planning. The result? Muted growth, fragile consumer confidence, and a world where supply chains are stuck in a semi-permanent state of stress. As Chris Williamson, chief economist at S&P Global Market Intelligence, warns, we're seeing supply chain delays mount and prices rise for consumers. Tariff relief offers temporary respite but doesn't address the root causes. Finally, there's the risk scenario, the one everyone dreads. If talks break down or political tensions flare, tariffs could not only return but escalate past previous highs. Remember, just a few months ago, the U.S. was threatening 145% tariffs. In this scenario, the global economy plunges into a deeper trade war. Supply chains become snarled or even fractured, leading to empty shelves, rising prices, and job losses on both sides of the Pacific. In a globalized world, it's not just the US and China who suffer. This shock radiates out to every country connected by trade, from Germany to Brazil to South Korea. What about inflation and consumer prices? While the temporary drop in tariffs is expected to provide some relief, especially for electronics, apparel, and toys, experts warn that inflationary pressures could quickly return if volatility emerges again. Jamie Dimon, CEO of JP Morgan Chase, recently cautioned, stagflation is not off the table. Geopolitical tension, persistent trade barriers, and fiscal deficits make this tariff pause insufficient to solve fundamental challenges. In other words, don't expect the price tags at your favorite stores to stay low forever. But with all this uncertainty, what lessons should we draw? How can companies, consumers, and even individuals protect themselves, or even benefit, from this rapidly changing landscape? First, for businesses. Diversification is no longer a luxury, it's a necessity. The days of relying on single-source suppliers, whether in China or anywhere else, are fading fast. Companies that move quickly to develop alternative suppliers, spread out their production, and build flexible logistics networks will be the ones who emerge strongest. Apple's pivot to India and VTech's move out of China are just the most high-profile examples. Even small to medium enterprises are now exploring nearshoring, reshoring, or tapping into a wider network in Southeast Asia, Mexico, or Eastern Europe. Second, investing in supply chain agility pays off. Those who prepared for volatility by maintaining healthy inventory levels, building relationships with multiple carriers, or investing in digital logistics were able to ride out the shocks of spring 2025 without missing a beat. As FedEx notes, paperwork and compliance readiness can make a huge difference. It's important for customers to have paperwork completed correctly ahead of pickup so shipments can continue to move seamlessly. For consumers, knowledge is power. Understanding why prices may fluctuate and which goods are most exposed to these geopolitical shocks can help you make smarter purchasing decisions. Electronics, apparel, and imported retail goods may see price swings over the next year, depending on whether the trade pause holds. Stock up during sales, seek out locally made alternatives, and keep an eye on news from major retailers and ports. These subtle signals often precede bigger changes on store shelves. And for investors, volatility means both risk and opportunity. The 90-day tariff pause has already sparked sector-wide swings in shipping, logistics, and retail stocks. Those with the best outlooks tend to be companies that show resilience and adaptability. Logistics giants with diversified networks like C.H. Robinson or FedEx, manufacturers willing to pivot production, and retailers nimble enough to pass on savings or ride out shortages. But beware, the companies most exposed to a single market or supplier remain highly vulnerable. Perhaps the biggest lesson is this: trade policy is no longer just background noise. It's a frontline risk, and sometimes an opportunity, for everyone in the value chain. Whether you're a supply chain manager ordering thousands of containers or a family shopping for back-to-school clothes, what happens in Beijing and Washington now hits home directly. So, does this 90-day truce lead us to stability and growth, or set the stage for deeper chaos? After weighing the evidence, it appears the answer is, both are possible, but only if key players learn and adapt quickly. The window of opportunity is short. In the best-case scenario, cooler heads prevail, deals are struck, and the world's two biggest economies find a way to compete without self-destructing. In the worst case, the brief calm is just the eye of a storm, with turbulence and uncertainty returning stronger than ever. And here's a secret the headlines rarely mention. The most lasting impact of this pause may not be in how much is shipped in the next 3 months. It's in the permanent changes now being set in motion. Future historians may look back and see May 2025 as a tipping point, when companies and countries realized the age of super-concentrated global supply chains was over for good. From here on, resilience, flexibility, and strategic planning will separate the winners from the losers. As we close, remember, this story isn't just about distant ports or executive boardrooms. It's about every package on your doorstep, every product in your cart, every dollar in your pocket. The global economy is being rewritten in real time, and you're a part of the next chapter. If you found this video insightful, hit that like button and subscribe for more deep dives into the moments and decisions shaping our world. Drop your thoughts in the comments. Do you think the US and China will finally reach a deal? Or are we heading into a new era of economic rivalry? And if you want to go deeper, check out our latest reports and expert